This is Cashflow Ninja, episode 23 with Mike Mauceli from Reef Oil and Gas.
Welcome to the Cashflow Ninja, the podcast empowering and inspiring people to discover how to generate their own income and manage, grow, and protect their own wealth in the new economy. Now, here is your host, MC Laubscher.
Hello everyone, MC Laubscher here, and welcome to another episode of the Cashflow Ninja. We have a fantastic show for you today focusing on energy, oil and gas. Now, oil is the most traded commodity in the world and also referred to as black gold. So we have an extremely interesting show for you today where my guest will talk about how you can directly invest in oil and gas projects to create income streams. So this isn't just buying stocks like BP or Shell or Exxon on the New York Stock Exchange. One of the big lessons I've learned is that there are many ways to invest in an asset class, and that's what truly separates the wealth strategies from the rich from what the poor and the middle class do. It's just not the asset class that they invest in, but the way that they invest in these assets. The rich and wealthy invest directly in oil and gas projects, creating income streams, and then benefiting because of the way that they invest from extremely favorable tax treatment. Just on a side note, I am not a tax strategist or a tax professional, and neither is my guest today. So please consult your own tax strategist or tax professional because everybody's situation is different. Now that I've gotten that out of the way, in general, there are three types of income that are all taxed differently, right? Earn income from your paycheck, which is taxed at the highest rate. Portfolio income from paper assets, and then passive income from real estate and directly investing in oil and gas projects. The government provides favorable tax treatment for people that provide housing, jobs, food, and energy. If you want to reduce your tax liability, you need to provide more housing for others, more jobs through businesses that you start, and provide more food and energy for others too. Directly investing in oil and gas, you're taxed on passive income. And there are other favorable tax treatments with this investment as well before, after, and during the investment is made. If you invest in oil and gas through paper assets in the stock market, like I'd mentioned, BP and Shell stocks, you're taxed at portfolio income. If you invest in these oil and gas stocks in your 401k, you'll be taxed at earned income levels when you start withdrawing that money from this plan. So you can already see the difference in tax treatment just in those three different areas of how you earn your money. If you understand that it's not the asset class, but how you are invested in that asset class that determines whether you'll be wealthy, middle class, or poor, the way that you look at assets and wealth will start to change dramatically. My guest today, Mike Mauceli, the CEO of Reef Oil and Gas Companies in Richardson, Texas, will talk to you about the strategy of direct investing in producing oil and gas wells that provides monthly cash flows and terrific tax benefits. Mike Mauceli is the founder and chief executive officer of Reef Oil and Gas Companies. In his 26-plus years as CEO, Mike has led the growth of the organization from a 3 full-time employee startup company in 1987 to a much larger oil and gas production and property acquisition company today, now serving the investment needs of thousands of oil and gas investors across the United States. Mike's vision and business acumen has made him one of the most influential CEOs in the oil and gas investor community. With Mike's leadership and determination, Reef will continue to offer energy investment opportunities that will have the potential to generate successful results. Before we are joined today by Mike Mauceli, just a reminder that you can download any book for free when you try Audible for 30 days. You can grab your free trial and audio book download at cashflowninja.com/free book download. And my friend Minesh Bindi from Gold Silver for Life is hosting a free webinar, 3 Steps to Cash Flow Gold and Silver. Minesh is showing people how to use their gold and silver holdings to create income streams. You can register for the webinar at cashflowninja.com/gold silver webinar. All of our past shows and show notes are available at cashflowninja.com, and you can also join our community and mailing list by texting the word Cashflow Ninja, one word, all capitalized, to 44222. That's 2 4s and 3 2s. If you sign up to join our community, I will email you 3 of the top 10 books ever written on building wealth.
Hey, this is John Lee Dumas from Entrepreneur on Fire, and you're listening to the Cashflow Ninja podcast with your host, M.C. Laubscher. You must be prepared to ignite.
Mike, thank you for coming on the show.
Well, thank you, MC.
Can you please share a little bit about your background and your journey in the oil and gas industry?
Yeah, actually, I am I want to say around a 30-year veteran of the oil and gas business. Actually, I started in the business in around 1978 when I worked for Tennessee Gas. Tennessee Gas is a transmission company, and so I always like to say I started from the bottom up because obviously they had pipelines that were underground, and most of the work that we did were field work. But in 1978, I moved to Dallas and started working for some small independent companies up in North Texas, and worked in of course, oil in 1980 had gone up to around $42 a barrel, which at today's dollars is, pretty much equivalent to about an $80 or $90 barrel price. And then of course we saw a downturn in the mid 80s, where prices had plummeted all the way down to around $12 a barrel. And myself and a partner started Reef in 1987. So, when prices were, at one of their lowest points, and, we felt it was a good time as far as to kind of venture out on our own, simply because, prices were low and there were some good opportunities out there as far as to pick up good projects. Reef basically started out as an exploration company, and up in North Texas and West Texas. And then, of course, we kind of focused our operations in South Louisiana, both onshore and offshore. In the late 90s, we took a 2 million acre concession in Argentina in the Northwest Basin and made one of the deepest discoveries in the country at that time, and was fortunate enough to sell out before the peso collapsed. And then, of course, we went to Canada and drilled, at the time, one of the deepest horizontal wells that had been drilled to date. And since then we have been both buying producing properties as well as participating. I guess over the last 4 or 5 years, we've primarily focused in North Dakota, and we participated in the drilling of about 900 wells. We owned a small interest under about 47 different operators. But to date, the company has owned an interest in right at about 3,000 wells and over 11 states.
Investing with you guys is a lot different than investing just in oil and gas stock like BP and Shell. So can you please share how investors invest with you guys and the difference between direct investing, what you guys are offering to the marketplace, and the value that you offer, in contrast with investing just in oil and gas shares and stock?
Yeah, well, it's a different investment altogether. And here you're actually participating in the physical drilling of the wells. Of course, our company, we have a full exploration staff. I mean, we have both geologists, engineers, reservoir engineers, and we basically do everything that a major company would do. We develop our own prospects. We buy prospects from third parties. And we physically put together the actual partnership where investors come in alongside of us, and we physically drill the wells. The investors get the benefit from the IDC, or intangible drilling cost deductions, that the federal government offers. And when we make a discovery, of course, the investors, we sell the oil at the wellhead to a third-party purchaser. And then, of course, once that oil is sold, then the investors receive revenue. We try to pay on a monthly basis. Some of our funds that are smaller funds pay on a quarterly basis, but the majority of them pay distributions on a monthly basis to the partners.
You've mentioned the tax treatment of direct oil and gas investments. So let's just talk about that. Obviously, the government provides tax incentives and favorable tax treatment for people that provide housing and energy and food, etc. Now, neither of us are obviously tax strategists or tax professionals. So for those listening, please consult your tax strategist, your personal tax professional with this, because everybody's situation is different. So now that we have that out of the way, what are some of the tax benefits and favorable tax treatments that these direct investments in oil and gas receive?
Well, let me say that's probably one of the most attractive parts and one of the main reasons why both individual investors and financial planners, put their clients into direct participations in energy projects. Some people use it for tax planning. Others, the IDC deductions or the intangible drilling cost deductions aren't as important. But we think it's definitely a plus. It's been enacted by the government, probably the U.S. government, for the last 35, 40 years. It was set up originally for investment in the energy business, so people or investors were willing to take the risk to develop and produce oil and gas here in the United States. So oil and gas is really the kingpin of all tax shelters that's still remaining. And for example, if you participate in the direct drilling of a well, you can write off all of the intangible items. And what I mean by that is, of course, your leases are a tangible item. The pipe you put in the ground are tangible. So those have to be amortized unless the well is unsuccessful. Now, if the well is a dry hole, and at the end of the drilling process, then the investors are able to write off 100% of their investment against their active income. If it is a successful well, for example, in some of the new horizontal wells that are being drilled around the world, you have intangible drilling cost deductions both on the drilling side, which represents probably 80% of the cost that you put into the investment, and then, of course, also when companies go in and frack the wells, that again is a large intangible item that is used in the completion of those wells. So what we call IDC deductions, which are the intangible drilling cost deductions, are very attractive.
Now, one of the risks, of course, when you're drilling, and you just pointed it out, is hitting a dry hole, so not finding oil or gas. How do you guys manage that risk for the investors in these investments?
Well, over the years, we have tried to develop different products because not every investor in energy wants to assume the risk of drilling exploratory wells. If you're physically drilling an exploratory well, say what we call a rank wildcat in our industry, is some of the jargon that is used, where there's not any production surrounding you and you're just going out trying to find a new reservoir of oil and gas under the ground, then the odds are a lot higher as far as having to drill unsuccessful wells. In fact, you could drill 6 or 7 dry holes before you made a discovery. There's different forms of risk in this business, and of course that's one of the most extreme forms, which we try not to do any exploratory drilling anymore. We focus primarily on what we call developmental drilling, where you have existing production surrounding you. Basically, you are, drilling in an existing field. So your odds, while there's always a risk, and you pointed that out, and anytime you drill a well, there's always a risk that you could have an unsuccessful project. But in some more of the unconventional plays or more of the developmental type of plays, you're going to find oil and gas, the majority of the time. The question is, how do you find commercial oil and gas? Because I always like to tell people there's a difference between having a successful project but having a commercial project, and that's where you really have to do your homework, and you have to have both reservoir engineers and engineers to go in and to figure out, what other wells have produced in the area, because you don't want to go into an area where say several of the surrounding wells produced a very small amount of oil, and someone's telling you that, you're going to find 5 times that amount of oil. That usually doesn't happen. So you want to make sure that you do all of the necessary engineering and the due diligence on the project before you participate in it. And that's where a company like ours comes in. I mean, a lot of people can drill oil and gas wells, but the bottom line is that you have to be drilling in the right areas. And I think that's how we do a good job of trying to manage the risk, because we do a lot of due diligence. That still does not guarantee, every well is going to work out. But what I like to tell people is that you have to, basically, if your goal is to participate in oil and gas, you want to make sure you spread that risk out over a number of wells and not go in and just participate in one, because if you're only planning on going out and doing one well, and you need to just save your money, because but if I've gotten a certain amount of money to spend, say I want to spend, over the next 5 years, I want to spend $250,000 or $100,000, whatever that amount may be, I want to put it in over 4 or 5 projects, because I'm going to have a better odds of making it. Now, if I don't want to take any risk, then you can buy existing production. That's, actually what you're doing is you're buying cash flow, and it's more of a price play. And we offer both of those types of products, because we know that not everybody wants to explore for oil and gas. Now, the tax treatment is different when you're buying producing properties, because physically what you're doing is you're buying cash flow. And in this market, that's not a bad thing to do, because obviously now you have the benefit of lower oil and gas prices. So you basically are, it's more of a price play. So if you can buy crude in the ground at, $50 a barrel, and hope over the next, if your outlook is that oil over the next several years, it's going to be back up to $75 or $80 a barrel, which I think is pretty reasonable, then, you want to sell or divest of that investment at that time. So usually what we like to do is to hold a property for 5 to 7 years, and depending on what prices are, then we want to exit that property at that time if we're buying production.
Doing some research for our interview too, I was looking at the different drilling techniques that's used today and the drilling techniques used previously. So what makes today's drilling techniques more effective than those used in the past?
Well, it all depends on the reservoir. When you come down to it, when you talk about drilling techniques, I mean, you have horizontal drilling, which has been the buzzword for the last 4 or 5 years, and hydraulic fracturing. And where that application is used, now, horizontal drilling has been around for a long time, 40 or 50 years. Fracturing has been around for 40 to 50 years as well. We have improved on that technology over the since around 2008, when these unconventional plays began to take hold. Now, what an unconventional play is actually, the layman way I like to explain it is that basically you're drilling into the hydrocarbon kitchen in most cases, because usually if you just imagine layers in a cake, and you have certain layers that have very porous sand or old riverbeds that are now covered up by, or covered or underground, that's usually where your hydrocarbons accumulate, is somewhere where you have good porosity and permeability. And the difference is in these hydrocarbon kitchens, they're usually a very organic rock that is under the ground that has very low permeability. If you look at a sponge, and you ever put a sponge under running water, the sponge will fill up with water, but it's very difficult to move fluid through that sponge. And the reason being is that sponge has good porosity. It doesn't have good permeability because it's a real dense rock. And so where the technique of horizontal drilling and hydraulic fracturing came about is physically you wanted to drill into that sponge, and then you wanted to go horizontal for a certain distance because you're opening up more of the reservoir, and then you come in with sand and water and you pump that in under extreme pressure. And of course your sand and your water goes out and forms little fingers inside of this sponge. And when you release the pressure, when you stop pumping pressure into the ground, then that rock tries to relax and close back up. And where the sand comes in, or the different propping mechanisms that they use, when that rock tries to relax, then basically it can't, because you pump sand into it or some kind of proppant which keeps those little fingers open. And that allows you to create permeability into the rock, which you're able to get that out. So these reservoirs, for example, the Bakken in North Dakota, which is a large reservoir, it covers roughly about 125 miles north-south and about 250 miles east-west. And so you have a very vast area of this rock, this real hard rock, that's difficult to get oil out of, and that's where these horizontal wells have been drilled over the last year. And it really does two good things, is that it basically reduces the footprint that you have on the surface. So from an environmental standpoint, you can drill more wells off of one pad, so you don't have the environmental impact if you would. For example, in the Bakken over the last 6 or 7 years, there's been over 10,000 wells drilled up there. You can imagine if you were drilling just vertical wells and you're drilling 10,000 of them, how much environmental impact you have on the surface. But when you're drilling a horizontal well, you're drilling down 10,000 feet, which is roughly 2 miles, and then you're drilling 10,000 feet horizontal. So you're physically drilling almost 4 miles of drilling, and you're drilling it, from one pad. And technology has continued to increase, where now you can drill 5 or 6 of these wells off of one pad. So it's very good. And of course, you open up more of the reservoir, you get more of the oil that's under the ground, and basically you have a smaller footprint on the surface.
Right, and you'd mentioned environmental impacts. Now, what strategies do you have in place that reduces the environmental impacts of the oil and the gas extraction?
Well, it's pretty much what I just said, because the technology has changed today, where now we're talking physically about the unconventional plays, and which I mean unconventional are the very large reservoirs we just spoke about.
Right.
And so technology has continued to change, and has continued. We've done a very good job in the industry on the drilling side of it. Hydraulic fracturing is continuing to improve. We've gotten our costs down, and one of the ways that the cost down is, and also the environmental impact has been reduced, is by using what they call walking rigs. And these are rigs that physically, have a lot of cases have big pads on the bottom that they physically can walk on the ground. So you reduce cost by not having to lower the rig every time you get through drilling the well. You reduce cost because you're going to drill 6 wells at one time. And how you do that is that you basically, in the drilling of a well, you're drilling a surface hole, then that surface hole goes down to cover all of your freshwater zones, your drinking water zones. So the first phase of a well is to drill through those freshwater, through those water zones, and then you basically cover that with pipe and cement. So you cement it all the way back to the surface, so you don't have any contamination of any freshwater zones. And one of the things here in the U.S., probably the U.S. is one of the most environmentally sensitive. We have strict environmental laws that the energy industry has to abide by, and so these are the ways that you do that. And then the second phase of the well, so in order to reduce the environmental impact on the surface, you'll drill. Say you're drilling 6 wells and you got them lined up in a vertical line, and that first hole is 1,000 feet deep. So you go in and you drill the first hole, You walk the rig over to the second hole, you drill that 1,000 foot to cover the freshwater zones, then the third, the fourth, the fifth, and the sixth. And then you come back and then you drill your vertical hole, and that hole may go all the way down to 10,000 feet or 9,000 feet. So then you come back and you drill all 6 of those wells, and you drill all 6 of those vertical holes at one time, and that's simply by using a rig, so it walks back and forth between those rigs, and that allows you to reduce your cost because you basically can drill those holes at the same time. You can buy all your pipe at the same time for 6 wells. So in a lot of cases, you can save 20 to 25% of the cost. The environmental impact is that you only use one set of tank batteries on the surface to hold the oil once you're producing it, but you can physically use, we drill with what we call drilling mud, and drilling mud basically is a chemical. It's mixed primarily water, but you do have some chemicals in it. And the drilling mud does 2 things. It lubricates the bottom of the bit when you're drilling it, but also it brings all the cuttings back to the surface. And all of these are done in tanks where basically they are enclosed in steel tanks. So by having this walking rig walk back and forth, you're able to reduce that environmental impact by using one set of tanks.
Now, business and investing are team sports, and you've mentioned that you have a very strong team in place consisting of geologists and the other team members in the areas needed to execute on oil and gas opportunities and projects. Can you walk us through a project of yours from the start where another party is bringing you an opportunity, or where you have identified the opportunity yourself?
Yeah, in fact, we have just, now this particular project is going to be a developmental project in Louisiana. We actually was brought this opportunity from what we call a generator or a generating geologist. The person that brought it to us used to work for a major company, and basically what his focus is to go into areas and look for developmental opportunities where you may have been an existing field, but you have a enclosure in that field that was not drilled previously that contains hydrocarbons. Now, how you find those opportunities is a lot of times you'll take what we call three-dimensional seismic. Three-dimensional seismic, I like to explain, it's kind of like a sonogram. Basically, what you're doing is you're putting sound down through the earth, and you have phones on the surface that allows you to see what's going on under the ground. And it allows you to see what we call structures or some type of fault enclosure where the rock has shifted, and all of a sudden you've got a separate compartment there that has oil and gas in it. And so first off, in this particular instance, we basically would send our geologist or our geophysicist. In this case, we use a gentleman that we've used in the past. That's an independent geologist and geophysicist, and of course we send him down and have him do independent mapping of the generator or the person that brought us the opportunity. And we determined that the separate compartment is there. We can see it on the 3D seismic. And then what we wanted to determine, okay, well, we know there's a separate compartment there, but the critical issue is, did this compartment move, or was it created after the oil had been produced, or was it there prior to the oil being produced? Because if it was created by some kind of geological event under the ground after the oil had been produced in that existing field, then it would already be depleted. And so the oil would have already been produced out of it. So we went in and first we determined that, and then we went back and looked at the chronological of when all the wells were drilled in the area, and we looked at from the beginning of when the wells were drilled all the way up until the well in this particular compartment, which was on the edge of it, had stopped producing in 2014. So just think of a hill under the ground. Well, oil is lighter than water. Usually oil sits on top of water. Natural gas sits on top of oil. So if you have an underground structure or an underground hill, and that hill basically is is full of hydrocarbons, and if you have a well that was drilled on the side of that hill, then if you can move higher up on top of the hill, you still have remaining reserves in that reservoir. And so those are the type of things we try to determine before we decide to move forward. And then our reservoir engineer, which is basically an engineer that looks at the size of the compartment. What we try to do is we take this particular compartment, the well that was drilled was right on the edge of it, produced about 250,000 barrels of oil. The play is that we can, from looking at the 3D seismic, we can move higher up on the hill, and we should have about 700,000 barrels of oil remaining in that reservoir. So what the reservoir engineers try to do is they go in and they put all that oil back in that had been produced in that container, and then you determine from the size of it what the thickness of the sand is. You want to know how thick the sand is, what the porosity in the reservoir is. The porosity is basically if you take a jar and you fill it full of marbles, the little spaces in between the marbles is the porosity. And then, of course, permeability is like the capillaries in your arm that move oil and veins that move oil and gas. You got to have permeability to move it through there. And so we try to do, we look at that aspect of it, and then they determine how much oil is remaining. And then, of course, our drilling engineer, we go out and we basically, in this particular instance, there's only 45% of the well remaining. The other 55% has already been placed with other investors. And so we review the drilling contracts, the cost to drill, and determine from that standpoint. And then that goes to our analysts, which our analysts, they look at it and determine, what amount of money is it going to take to pay the well out? What amount of money is it going to take to pay or how much oil is it, versus at today's dollars? Now, one thing you really can't get a handle on is what is the price of oil going to be. And so what most companies use is that they use the standard of, West Texas Intermediate is kind of the standard crude. If you open up the newspaper today, you probably see it's trading for about $51 a barrel. But you look at the strip prices, and the strip prices is basically a estimate of what if you were to sell oil today to someone if I wanted to buy oil, if I was a corporation and I wanted to buy oil 2 years from now, if I wanted to buy 1,000 barrels a day, I can look at that strip price and I would pay that price for it today to be delivered in 2 years. So the strip price is what a lot of companies use to estimate the price. And that determines what your return is going to be. And usually what we like to see on these types of plays is a potential for about a 3 to 5 to 1 return to our partners. And it met all of that criteria. And so we are going to move forward with that particular project. But that's how an exploration well works.
Oh, great. Thank you for sharing that. So let's talk about specifics. What are the minimum amount that investors need to invest with you guys, and do they need to be accredited investors?
Well, on our particular projects, that varies depending on whether or not it's a drilling project versus a income fund project, and depending on the cost of the projects. But we do sell under the Reg D 506C registration, where we work with accredited investors only. Now, we have done both public funds in the past and obviously, but the 506Cs, they're less expensive to do, but we do work with accredited investors, and an accredited investor is an investor that has theoretically $250,000 a year income, or has $1 million net worth, or has made $250,000 over the last 2 or 3 years, or has $1 million net worth. So investment ranges vary depending on the project. Usually, what we will sell is a $100,000 unit with a $25,000 minimum. We have done as low as $10,000 or $15,000 minimums. So it really depends on the different types of projects that we do.
Now let's talk about the oil and gas industry right now. How does the low price of oil affect investors or potential investors?
Well, again, it depends on when you, if you've been active in the business as we have. I mean, it's a lot like the stock market or any other type of business. I mean, basically, if you bought oil back when oil was $100 a barrel, you're probably not making a very good return on your investment right now. And
Right.
and so a lot of people, obviously, we've seen that in the industry. I mean, we've seen close to 100 companies go bankrupt over the last year to year and a half, and there's probably some more to follow. But so as an investor, you really want to try to, it's like I said. I mean, if I'm an investor, I don't want to go out here and just invest one time. I mean, if that's my attitude, that I'm going to give it one shot and that's going to be it, then I would tell that individual that probably you need to buy bonds or something along those lines that obviously has a lot less risk, because oil and gas, as we've said earlier, I mean, there are inherent risk involved depending on whether you're drilling or whether you're buying production. And of course, if you're buying production, you bought cash flow, and over the last year or so, the cash flow has been very low. But if you buy in today and you look for the, obviously the valleys of when prices drop, I think an investor has a lot more opportunity today, because if you're buying oil at $100 a barrel, or you're drilling at $100 a barrel, then the economics have to be a certain point for you to make money, and they have to stay in that $100 a barrel range. And what we've seen over the last couple of years, now you can buy hedges that hedge against that downside, but usually hedges are only last for a couple of years, and that's what we've seen in the industry. I look back when I got into the industry in 1987, and I look back over that time frame. I mean, we've seen a lot of ups and downs in the price of oil. I mean, we've seen, the Arab overproduction in the early 80s, which caused the price to drop from $42 a barrel down to $12 a barrel. We saw, a number of times the Asian crisis that obviously we saw other dips in the prices. So there's been about 15 dips in prices. And of course, prices have always recovered. And they will do that again this time, and we're already starting to see that effect. I mean, this time, of course, we saw Saudi Arabia and really technology, cause an oversupply in oil. So basically, we have had to wait for that oversupply to slowly get worked off, because obviously investment stopped in the U.S. and so prices dropped down to as low as $27 a barrel, and now they're starting to recover. And we think they'll recover, back up into the 80s over the next, couple of years. And it's what kind of our outlook is. I don't know that we'll reach $100 a barrel, but we're certainly going to reach back into the 70s or $80 a barrel. And so, it's a good time to enter, as I said earlier, because one, whether you're drilling wells, if you're drilling wells, you're drilling at much lower cost now. You have lower acreage cost to purchase the acreage. So you have lower completion cost, because everyone's, that's working, obviously, are working for reduced costs. As prices recover, of course, all the prices of your services start to go back up. And when oil was $100 a barrel, service companies were basically looking at it and saying, we have to put on all these people, so our cost of services has gone up, and now they've dropped. I mean, you could drill a well today, a well that was costing you $10 million back in a couple of years ago, you could probably drill today for about $7.5 million. So obviously the cost is less, and of course the price that you're getting for the product is less as well. But buying production, you're buying it at today's prices. So if I'm an investor where I'm buying cash flow, now I feel I've got another advantage, because obviously I don't have to depend on prices being at $100 a barrel to make money. I've got room to basically invest, and then of course as prices go up, which is going to increase the value of my investment, obviously, and that all depends on when prices go up, because remember, oil and gas is a depleting asset. I mean, basically you're depleting one the day you put it online, you're just slowly depleting that asset. And
Right.
but by buying at today's prices, if I can buy crude in the ground for $40 a barrel and my price goes to 80, then And we've been very successful in doing that in the past, and as well on our income fund products is to buy low and of course sell when prices recover. So I think it's a great time to invest myself.
Now, Mike, in business and investing, what's the best advice that you've ever received and the most important lesson that you've learned on your journey?
Well, in this business, you learn lessons every day. And I think having a clear strategy on, I think everybody from every industry and any type of investment, whether it be real estate or oil and gas or any type of investment, obviously, is knowing when to get in and, of course, when to get out. It's always good to be able to go in with a strategy where, I'm not tied to that strategy, but the bottom line is if I'm buying production or if I'm drilling wells and I hit a good well, I want to hold that well until, to get the upfront cash flow off of it, then try to look at a strategy to exit it in 5 to 7 years and redeploy my capital. I think that's one of the main things that you need to look at in this business. Okay, well, I understand the tax advantages. I understand that, the risk, and hey, I go out and I invest my money and we make a nice discovery. Again, it is a depleting asset, so you want to try to look at when to exit that asset. And so that's always a good strategy to look at. Secondly is that when you're buying oil at high prices, you want to definitely hedge. When you're buying at low prices, you want to try to cover your downside or investing. So you want to use some type of hedging strategy. And you can get costless collars. I mean, you can buy floors. If you're buying a floor, which what I mean by that is, say, for example, today, if I make a discovery and I'm producing oil and say I want to buy a $40 floor, well, a $40 floor may cost me 50 cents a barrel or 45 cents a barrel, but it covers that downside in case we do run into a lower market again. And the problem that a lot of people saw back when oil was $100 a barrel, when you're trying to lock in hedges, and the reason why a lot of companies didn't lock in long hedges is because what we call the forward curve, when you look out 2 or 3 years when prices are high, that curve is dropping. And now when prices are low, it's increasing. So you want to make sure you got some kind of hedging strategy in place to cover your downside once you make the discovery.
I like that. Very strategic in your approach, strategic in your execution, and strategic in your exit strategy, and then protecting the downside. Fantastic. Now, a question I ask of all of my guests is, if you cannot pass on any money to your children and grandchildren, and you're only allowed to pass on 5 principles to them to build wealth and achieve happiness and success, what would they be? Well,
I always tell people, and it's kind of like, one of my mentors and one of the guys that I look at, and I've done speaking for Robert Kiyosaki, and, I've consulted with him on energy. And one of the main things, that I've picked up from him is that you want to have a good team. And basically you want to have, you want to set up your corporations correctly. You want to have a good attorney. You want to have a good tax advisor. You need to have a good strategy as far as you begin to make money to understand, how you want to set your corporations up, that you don't have personal liability for it, and you want to make sure that your family's protected and everything that you've worked on and you've built, you want to make sure all of that is protected. So you got to have a good team. You also have to have, if you invest in real estate, whether you're investing in real estate, you invest in oil and gas, or you invest in the stock market, you want to pick a person that you feel has been successful in those investments, and you want to basically work with those groups and try not to spread out too much, because obviously you start to lose. Everybody has a good story. I mean, the bottom line is, what I like to say is, when you're talking to salespeople or you're talking to people about investment, I mean, everybody has their own strategy, and you need to figure out and kind of follow your own basic principles, and because nobody can do it, nobody understands your personal risk tolerances or your personal investments better than you do, and you need to make sure things make sense to you in order before you do it. So that's kind of my strategy and that I've lived by. And when you create enough wealth, then try to protect that wealth. It's one thing to try to be greedy, but the bottom line is you need to have some type of asset protection in there that as time moves on, you're constantly reevaluating your position, and when you get enough wealth, you want to make sure that obviously you're not still out there trying to just be greedy and because you make mistakes then. So that's kind of my thoughts on it.
Are there any books that you would recommend to my audience if they wanted to learn more about the oil and gas industry?
Well, I actually have a book that I'm finishing now, of course.
Oh, great.
That I should have on the, out here in the next probably 90 days, I'm hoping. But anyway, I've been working on it, but there are plenty of good books out there depending on the reader. If you're more of a technical reader, then obviously The Prize is probably one of the best oil and gas books to understand the history of the industry. And I think it's Daniel, but it's called The Prize. And then he has a new book out that I've read, but his books are long, but it gives you a complete understanding of the industry itself and where it's gone from basically in the early 1900s to where we are today. And so there's a lot of good books out there as far as on oil and gas, but that would be one that I enjoyed reading, and it's a very long book, but it does tell the historical point of view of it. And then of course there's some books out there that talk about kind of the reserves that are in the world. One of the things that the U.S. knows very little about is how much actual reserves that Saudi Arabia has, or because once the Saudis basically removed the U.S. companies and kind of nationalized Aramco, then they stopped reporting their reserves. And when you look at a country like Saudi Arabia that basically has 400 to 500 wells in the entire company, as opposed to a country like the U.S., we've probably got 700,000 wells. It's a big difference. Their reservoirs are much more efficient, but their reservoirs obviously have been producing for a very long period of time, and it's very difficult to determine, kind of what type of reserves they have left, and so, stuff like that you basically, if you're trying to predict what the price, what oil is going to do in the future, because let's face it, hydrocarbons are probably going to be is the most cheapest form of energy compared to solar, compared to wind, and probably will continue to be for the next 25 to 30 years. And so we will continue to use oil and gas and natural gas and until at some point when the renewables become more efficient, or there's some type of new technology out there that makes them actually profitable. And so understanding, kind of what the philosophy is on oil and how much oil is left in the country, in the world, we use right now in the world probably 82 million barrels of oil a day.
Wow. In
the United States. If you look at countries like China, you look at India, which is kind of the sleeping giant out there. China has over 1 billion people in the population, and they are probably the third largest consumer. If you look at the U.S., we have a population of roughly 300 million people, but we use more oil in the world than anyone else. Right. But you look at India. India has over a population of over 1 billion people, and they use very little hydrocarbons. So as those countries continue to develop in the future, I know we've seen a downturn in Asia right now, but the bottom line is as those countries continue to increase and more people drive cars or use technology that are all hydrocarbon based, technology that, the price of oil is going to continue to rise over the years to come, and until there's some other form of energy out there that's going to be able to start taking its place. And to date, that hasn't happened. I mean, a lot of people preach wind and a lot of people preach solar. And of course, we've seen over the last year that several of the government's solar projects have gone bankrupt, the largest being Solyndra, I think, which is a $450 million bankruptcy that the taxpayers had to pay for. And so that hasn't happened yet. And so hydrocarbons are going to continue to be a very strong part of our of our economy.
Now, Mike, how can my audience learn more about you, your company, and keep informed of all of the projects that you and your company, Reef, are involved with?
Well, you can actually give us a call at 1-877-915-7333. You can either talk with myself or my brother. You just give us a call, and my name is Michael Mauceli. Of course, my brother, he handles the relationship with a lot of our investors, and so his name is Paul Mauceli. And of course, we have a complete staff of people that obviously we work with, both financial planners and private investors. Or you can go to our website at www.reefogc.com, and you can learn more about us there.
Perfect. Well, thank you for coming on the show and sharing your knowledge and your journey and providing so much value to my listeners. It was a pleasure having you on. Thank you so much.
Thank you very much, MC, for inviting me. I appreciate it.
Thank you for joining me and my guest, Mike Mauceli, the Chief Executive Officer of Reef Oil and Gas Companies. Remember to grab your free audiobook download from Audible. You can download any book for free when you try Audible for 30 days. You can grab your free trial and audiobook download at cashflowninja.com/free book download. And just a reminder to sign up for the free webinar hosted by my friend Manish Bendy from Gold Silver for Life, 3 Steps to Cashflow Gold and Silver. Manish is showing people how to use their gold and silver holdings to create income streams. You can register for this webinar at cashflowninja.com/gold silver webinar. All of our past shows and show notes are available at cashflowninja.com, and you can also join our community and mailing list by texting the word Cashflow Ninja, one word, all capitalized, to 44222. That's 2 4s and 3 2s. If you sign up to join our community, I will email you 3 of the top 10 books ever written on building wealth. If there's any way that I can provide more value to you and serve you better, please go to our contact page and send me an email or leave me a voicemail on our SpeakPipe voicemail line. That's our show, everyone. Until next time, live a life of passion and purpose on your terms.
You have been listening to the Cashflow Ninja with your host, MC Laubscher, the podcast empowering and inspiring people to discover how to generate their own income and manage, grow, and protect their own wealth in the new economy. Today's show notes and resources are available on our website, cashflowninja.com. This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objective, situation, and needs. We believe the information provided